The dollar's fall gave a huge boost to commodities like gold. And here's what our own Carter Worth said about bullion just a couple of weeks ago.
What we know is the low in GLD was literally intraday low 100.23. The high 122.37. That's a $22 rise. We've given back exactly a third. 7 times 3, 21. So a one-third retracement. And today we closed at or near the high. We bounced quite well and closed almost at 117. But you have the visual there. This is an opportunity by my work. We would get long gold if you're not already there.
OK, that was the view a couple of weeks ago. Now the chart master sees another way to play gold. Carter, how are you looking at it?
You know what's happened, of course, here is as gold's continuing commodities in general, the gold miners, where there's a lot of gearing, a lot of leverage by virtue of debt, they have come to life in a crazy kind of way. And we've got some really good charts, I think, that'll put this in perspective. But the stats here, I just wanted you to start with this. This is the actual GLD from its structural low and the gold miners. Now, you're going to expect this kind of thing with beta and with the leverage associated with an equity versus a commodity. But at this point, we think this is a bit overdone. So again, 100% versus 24. So I wanted you to look at, since the data begins, and this is a very old index, the gold and silver index, the XAU out of Philadelphia, what we know is that this ricochet is now the steepest. It's 3 months. It's the steepest 3-month move on record. And it is drawing in either shorts who are forced to cover or people who are quite late and are getting involved, which we think is late. Yeah. So a couple of things I want to look at. Here is the GDX, and what the top panel is simply the GDX and its 150-day moving average. And what the bottom panel shows is the percentage above the 150-day moving average. We are right now at 52%, higher than at any point in the past 10 years. So again, you can use phrases like overbought or crowded or complacent, but we think it's pricing in a lot. A couple other things I wanted to look at. You can draw your lines this way. You have something of a downtrend you've reached. And so here's our day-to-day chart. You know, we've completed this formation. You've had your head and shoulders bottom, and we think it's going to stop here. So if one's long and have captured these gains, I would grab some. If not, we think you can catch this as a short, and it's likely to fall back here. So we want to sell GDX.
Sell GDX. Mike, what do you think?
Well, first of all, I mean, it was a great bullish call that he made. I mean, it's not too many times you get to make a call with a short time double that we've seen in GDX in the meantime. But one of the things that sharp move has meant is that options premiums have gotten quite high, and financing basically a bearish purchase at this point is going to get kind of expensive. In fact, if you take out a look at the straddle, basically, in GDX right now going out 30 days, that's buying the call and the put. It's going to cost you way over 10% of the current level of GDX. So just going out and buying options is kind of a tough thing to do. So what I'm looking to do is try to help finance a longer-dated bearish purchase by selling a near-dated option. Specifically, what I was looking at was the May-July 25 put spread. You can spend $1. Pay $2 for the July 25 puts, sell the May 25 puts for $1. Basically, cut that cost in half. Now, that first option is going to expire in less than 1 month. Obviously, you've got all the way out to July, though, for the bearish bet on the longer-dated put.
Hey, listen, this is a brilliant way to do it if you want to define your risk and try to pick a top, because I agree with everything these guys have just said, but it's not too different than what we were just talking about in Walmart. You need to find ways to finance options in the sort of market we've been in. I know that this week felt a little volatile, but think about the slow creep that we've had for 2 months now, and that's been really hard to be long premium options. I'll just make one other point about the GDX. This top 7 strikes of open interest are all puts, and people have been trying to do this the whole way up. The June, I'm looking at the June 18 puts, the June 14 puts, the May 18 puts. So trying to pick a top is a difficult business. I think the way these guys are trying to do it makes a lot of sense.
Right, and then one could say there's structural versus tactical, right? I mean, structurally, if and as this debt disaster that we all know it is going to play out the way it does, gold can go much, much higher. But on a tactical basis, after a 100% move, your biggest 3-month move on record, we think it's, capture some gains here.
You know, one of the things about going out to July also is that what could cause gold and other commodities to fall very sharply? You could see maybe some action from the Fed. Maybe you could get something in June, or even just breathing about it could obviously cause that kind of, but you're not likely to get it between now and May expiration, which is the reason I chose the expirations that I did.